Hey everyone, and welcome to This Explainer. Today, we're diving into the absolute heavyweight championship of investing, SIP versus lump sum. So do you take all your cash and drop it into the market at once, or do you play it safe and spread it out carefully over time? It's honestly one of the biggest financial dilemmas out there. So we're going to look strictly at the data today to see exactly how each of these strategies actually works under the hood. To really wrap our heads around the stakes here, I want you to picture something for a second. Imagine you've got a fresh 10 grand sitting right there in your hands today. Maybe it's a huge bonus from work, or maybe you've just been aggressively saving up. Well, now you're forced to immediately confront one of the most genuinely stressful aspects of personal finance, and that's market timing. Do you push all those chips into the center of the table right now, just hoping the market is on an upward swing? Or do you hold some back, trickling it in slowly just in case things take a nasty turn? And man, that anxiety is so real, isn't it? Make the right move, and you could build phenomenal, compounding long-term wealth, literally putting yourself years ahead of your goals. But make the wrong move, you might watch your hard-earned money just vanish overnight. There is this massive, paralyzing psychological fear of dropping $10,000 today, only to open your portfolio app next week and see it's tanked by 20%. So let's break down exactly how these two strategies operate to help you navigate that exact fear. All right, first up in the ring, lump sum investing. We all know the drill with this one. It's deploying a single large amount of capital into an asset all at once. And this strategy feels incredibly natural when you get a sudden financial windfall. If you sell a business, get an inheritance, or land a massive year-end bonus, your gut instinct is usually just to get that money working for you right away. But because literally all of your capital is exposed to the market on day one, it comes with some very distinct immediate risks. Now, in the other corner, we have the systematic investment plan, or SIP. This is all about automating smaller recurring contributions at fixed intervals, like, say, $200 on the first of every single month. What makes SIP so incredibly powerful is how it acts as this low-stress framework for the average earner. It aligns perfectly with how a regular paycheck actually flows into your bank account, rather than just sitting around waiting for some giant once-in-a-lifetime windfall. So what we're really doing here is pitting two very mechanical investing philosophies directly against each other. When you use an SIP, you're relying heavily on dollar cost averaging. But when you go with lump sum investing, you're leading entirely into maximum time in the market. Let's peel back the layers on both of these concepts to see exactly how they handle your capital, and more importantly, how they handle the inevitable roller coaster of the stock market. Okay, let's unpack the mechanics behind the SIP approach first. By automating your buys, SIP naturally kills your market timing anxiety through dollar cost averaging. Just think about the sequence here. When the market drops, boom, your fixed monthly amount suddenly buys way more shares because they're on sale at a massive discount. Then, when the market inevitably bounces back up, that exact same dollar amount simply buys fewer shares. Because you're buying constantly, completely regardless of the weather, you are inherently averaging out your cost per share over time. The math just does the heavy lifting for you. On the flip side, we've got the core engine driving lump sum investing, which is time in the market. The philosophy here is super straightforward. Historically, over the long haul, stock markets rise. Therefore, getting all your money working immediately on day one capitalizes on those long-term upward trends. You aren't leaving any cash just sitting on the sidelines waiting for its turn. Instead, every single dollar gets the absolute maximum amount of time to grow and compound without any delay. And here is where the math gets absolutely fascinating. If we look strictly at the historical data in a vacuum, studies actually show that lump sum outperforms SIP roughly 60 to 70% of the time. I mean, that is a massive statistical edge. Why? Well, because more often than not, the broader market is going up. If you trickle your money in over a year during a strong bull market, you're really just buying the exact same assets at higher and higher prices. You're effectively missing out on the initial growth your lump sum could have captured right there on day one. But yeah, there's always a but. We have to talk about that remaining 30 to 40% of the time. This is where the caution comes in. If you are unlucky enough to invest your massive lump sum right before a market crash or a major prolonged dip, the cost averaging power of the SIP becomes the undeniable champion. The SIP investor is going to seamlessly ride that downward wave, steadily scooping up shares at lower and lower prices. Meanwhile, the lump sum investor, they're just stuck, waiting, painfully I might add, for their initial portfolio value to finally recover. This setup brilliantly illustrates exactly which strategy matches your specific financial environment and risk tolerance. If the broader market is super volatile or bearish, SIP is definitely your best choice because it cuts down anxiety and buys those dips automatically. Now, if we're in a roaring bull market, lump sum takes the crown because it gets your capital working before prices shoot up even more. And hey, if you're just a standard investor working with a regular salary, SIP remains the clear winner because it builds incredibly disciplined habits without needing massive upfront savings. But what if you find yourself somewhere right in the middle? Say you just sold an asset or you got a big inheritance, but the sheer terror of market volatility is just too paralyzing to drop it all in today. Well, there's actually a highly effective hybrid approach called the Systematic Transfer Plan, or STP. In this kind of windfall scenario, you put your large lump sum into low-risk liquid funds just to keep it safe and earning a tiny bit of yield. Then you automatically transfer it into your primary, riskier investments via an SIP over, say, 6 to 12 months. It's awesome because it perfectly blends the initial capital deployment of a lump sum with the psychological safety and cost averaging of an SIP.
Okay, so how does this build a clear action plan for you? Well, the final verdict is wonderfully straightforward. If you have a lump sum and a high-risk tolerance, the historical data firmly favors putting it to work immediately. But if market volatility keeps you up at night and totally stresses you out, SIP is undeniably the smartest, stress-free route. And if you're simply investing out of your monthly earnings, SIP is hands down the foundational tool to build disciplined, long-term wealth.
At the end of the day, personal finance is exactly that. It's personal. It's about understanding the mechanics of these underlying strategies and then applying them seamlessly to your own unique situation. So think about your own income flow. Think about your own risk tolerance when you inevitably look at a sea of red in the markets. Knowing what you know now about dollar cost averaging versus time in the market, which of these two heavyweight contenders are you going to choose to build your wealth today?